Alright, so in this video, I'm gonna cover Section 3 Inventories. So this is for CMA Part 1. Lesson 3 is Assets. So basically, I'm just gonna discuss the theories first, or the theoretical part, and I'm gonna do a separate video for the calculations since it's gonna be too long and quite complex as well. And I think it's important for you to have a background first about the theories and other definitions under the inventory topic. Alright, so now we have here the outline. So first, I'm gonna talk about, or I'm just gonna introduce to you what we mean by inventories. Second, what is the initial measurement of inventories? Third, what are the two inventory accounting systems? So we have two, the perpetual inventory system and the periodic inventory system. Fourth, what do we mean by inventory physical count? Fifth, what is inventory cost flow method? And sixth, what is the subsequent measurement of inventories per the accounting standards? Alright, so first subtopic here, let's first define inventories. So per IAS 2 or International Accounting Standard 2, so the scope is inventories include, so first we have here assets held for sale in the ordinary course of business, or what we also call finished goods. Second is the assets in production process or the work in process. Third, materials and supplies to be consumed in production. We also call these as raw materials. Now, let's differentiate each one. So when we say assets held for sale in the ordinary course of business, so for example, this applies to trading companies. So those companies wherein they buy and sell items, whatever they have bought, which are not yet sold. So these are assets or items held for sale, which are in the ordinary course of business. Meaning, when we say ordinary course of business, the company is generally involved or engaged in a trading business. So it's like a company is buying and selling finished products. So that is the business of a company. So the second item here, when we say assets in production process or work in process, so these applies to manufacturing companies. So of course, in a manufacturing company, right, so they are processing materials, right? They're processing materials, and of course, generally speaking, it takes time for the processing of the finished goods. So those items which are currently in process but are not yet finished, so these are what we call the work in process inventory items. Okay, so we also include these as part of the inventories line item, specifically in the financial statements. So third, when we say materials and supplies to be consumed in production, these applies to manufacturing company. So for instance, a manufacturing company is processing a particular product, right? So of course, they cannot process a particular product unless they buy some materials and supplies. So it's understandable these are materials which have not yet undergone any processing. Okay, so I hope that's clear. So just a recap, we have here finished goods, or those goods which are for trading companies, for instance, those goods which are readily saleable. So once they buy, these items are ready for sale. So the second and third point here, so work in process and raw materials, basically these applies to manufacturing company. Okay, so classification, we have here the classification. Generally, it's current asset. Okay, so why do we say that inventories are classified as current asset? Basically, it is expected to be realized in cash or sold or consumed during the normal operating cycle of the business. So remember in lesson 1, I've discussed about the meaning of normal operating cycle. So when we say normal operating cycle, it is typically the period within which a business is expected to turn over its inventories, right? So for instance, this is the period from the moment they buy the inventories and period within which they expect to sell these inventories. So it is expected to be realized in cash. So realized in cash meaning company sells it or sold or consumed. So not necessarily inventories which are for sale. So for example, so we have here materials and supplies, right? And then work in process. So generally, so these are not readily available for sale. In this case, these are inventory items which are to be consumed. Still, these are to be classified under current asset in the financial statements. Okay? I hope that's clear. So initial measurement. So please remember, inventories have two measurement. We have initial measurement and then subsequent measurement. So later I'm going to discuss further what we mean by subsequent measurement. So initial measurement, meaning how do we record or measure inventories at the initial point of recording. So here we have, let's distinguish first if it's a trading company. Of course, inventory costs should include, we have 3 points here. First is the cost of purchase, net of trade discounts received. Second, import duties and other unrecoverable taxes. Third, we have handling, insurance, freight in, other costs incurred in directly bringing the items to the present location or condition. So first item here, when we say cost of purchase, so basically any inventory item that a company purchased, right? So there's a consideration, or let's say in simple words, money in exchange for that particular inventory item, correct? So whatever is a consideration or money that the company pays, that's part of the cost of purchase. Now here, take note, we should deduct any trade discounts received. So for example, if a particular company purchased an inventory item, say for instance, there's a 5% discount or 10% discount from the supplier. So generally, we should only include, say for example, if it's 5% discount, we should only include in our inventory cost the amount which is 95% of the gross amount, right? So it should be net of any trade discounts. Now, trade discounts can either be cash discounts, volume discounts, and so on. Second, import duties and other unrecoverable taxes. So, we all know that certain inventories, when we purchase them, companies impose taxes or duties. So, these taxes, take note, unrecoverable taxes and other import duties should be included as part of the inventory cost. Third is handling, insurance, freight in, and other costs incurred in directly bringing the items to the present location. So it's understandable whatever shipping costs, freight in, and other costs which a company has incurred should be included in the cost of the inventory items. Okay, so now let's go to the initial measurement for a manufacturing company. So we have 3 here: direct materials, direct labor, manufacturing overhead costs, and these include fixed and variable manufacturing overheads. Okay, so we all know that in a manufacturing company, so basically a manufacturing company consume resources whenever they process products, right? So for example, of course, number 1, they will need direct materials. So these include raw materials, supplies. For example, if a company is processing a car, so a car, right? Before we have the finished product, there are many items there. So for example, the machine, the engine, other parts there. Second is direct labor. A manufacturing company cannot have a finished product just by having direct materials. So it needs processing, right? So these include direct labor. So for example, let's say it's not a complex product, like for example, the creation of a particular bag, right? So it involves hours. Say for example, we have a handmade product. The person who did or who processed the handmade product has incurred some labor hours. So whatever costs that the company paid to that person to make that particular product, it should form part of the inventory costs. Okay, so point 3 here, manufacturing overhead costs. So we have here fixed and variable manufacturing overhead. Let's first differentiate fixed and variable manufacturing overhead. So when we say fixed, of course, the amount to be paid is fixed. It doesn't vary, right? So when we say variable, it means that the cost depends on a particular variable, okay? So for example here, let's say for example, a manufacturing company typically has a factory, correct? A company either rents that factory, okay? Actually, the rent expense for that particular factory, since the amount doesn't change per month, considering, for example, if there's a lease agreement or rental agreement per month, correct? So when we say variable manufacturing overhead, so for example, machineries, right? So machineries consume machine hours. So how many hours did it take for the machine to produce a particular product, correct? So whatever is the cost allocated for those machine hours, we include this as part of the inventory cost. Okay, so I hope that is clear. Take note that when we say inventory cost, it doesn't include all costs incurred related to a particular inventory. So we have here exclusion. Number one is abnormal waste. Second, storage costs. Third, administrative overheads, which are unrelated to production. Fourth is selling cost. Fifth, foreign exchange differences arising directly on the recent acquisition of invoices invoiced in foreign currency. Sixth is interest costs when inventories are purchased with deferred settlement terms. Alright, so first, abnormal waste. So it's understandable, right? A particular manufacturing company typically incur waste, right? For example, if there are errors in the production which are abnormal, not within the normal range of errors. So these are abnormal waste. Okay, so these should not form part of the inventories. Second, whatever is the storage cost. So for example, if a company has finished the production, of course, they need some storage where they can store the finished product. So whatever the cost incurred for that storage, then it shouldn't form part of the inventories as well. Third is administrative overheads. So for example, those admin people which are not related to the production process of the company should not be included in the cost of the inventories. Fourth is selling costs. So for example, a finished product, right? So a company typically incur costs. For example, marketing costs, distribution costs, selling costs. This should also be excluded in the cost of the inventory. Fifth is foreign exchange differences. So for example, if a company has purchased some raw materials or inventories which are denominated in foreign currency, or for example, it's from a foreign supplier, so any foreign exchange differences, it shouldn't be included as part of the inventory cost. Any foreign exchange differences, typically, we include it as unrealized foreign exchange gains or losses. And then corresponding account there is either receivable or six is interest costs when inventories are purchased with deferred settlement terms. So for example, a supplier has granted the company a certain period upon which the company can pay the inventories purchased, right? So there's a stipulation pertaining to the interest rate or the interest. Whatever is the interest computed for that shouldn't be included as part of the inventory cost. So it should be expensed outright, which is typically as a finance cost. Okay, so we have here inventory accounting system. So as mentioned earlier, we have two: perpetual inventory system and then the periodic inventory system. So let's differentiate each one. So when we say perpetual inventory system, so here purchases and other items related to inventory costing are charged directly to inventory, and then inventory and cost of goods sold are adjusted as sales occur. So under perpetual inventory system, whenever a company purchases inventory items, these purchases are directly recorded to the inventory account. And whenever a company has made a sale, for instance, a sale transaction, the transaction is immediately reflected in the inventory and cost of goods sold account. On the other hand, when we say periodic inventory system, so here, point 1, goods bought from suppliers and other items related to inventory costs are tracked during the period in a separate temporary account or purchases. So here, whenever a company purchases some inventory items, these are not immediately reflected in the inventory account balance. Rather, a company has a separate listing, a purchase listing or a monitoring to track all these inventory purchases. So basically, the beginning inventory remains unchanged, or the balance of the inventory in the accounting system is unchanged until the end of the period. You might ask, how does the company reflect the changes in the inventory items, right? So what happens here is that changes in inventory and cost of goods sold are recorded only at the end of the period, and that is when a company conducts a physical inventory count. Okay, so normally a company conducts physical inventory count so that a company knows how much inventory does a company really have at a particular period of time. So now let's discuss in great detail what do we mean by inventory physical count. So here, a physical inventory count is a process of counting all inventory items as of a particular period. So what happens here is the management conducts the process of counting all inventory items. So now let's discuss what inventory should be included in our inventory balance at the end of the period. So we have 3 points here. First is the goods at the location of the physical inventory count, meaning we should include in our inventory balance the amount of the goods which are at the location during the physical inventory count process. Second is goods in transit. So for example, a company has purchased certain inventories but the terms of the inventory is FOB shipping point, correct? Meaning the inventories are already owned by the company upon shipping, okay? So in this case, the purchase inventories are not yet at the physical location of the company. However, the company already owns these inventories. Thus, it is only fitting and proper to include this in the inventory balance. Third is goods out on consignment. So for example, if I am a trading company, I have certain inventories which are displayed in particular shops. So we call these as goods out on consignment, meaning it is not in my physical possession as of the moment. However, these are still mine. I still own these inventories but are only displayed in a particular shop. So we still include this as part of our inventories. So let's have a differentiation here. So under perpetual inventory system, so the difference between the physical count and the inventory per books, we recognize this as part of the cost of goods sold. On the other hand, under the periodic system, the amount of cost of goods sold for the period includes first, the inventory cost of goods sold, and second, the inventory shortages or overages. Okay, so now let's talk about the cost flow method. We have here specific identifications. Second, moving average method. Third is weighted average method. Fourth is first in first out, or we also call this as the FIFO. Fifth is the last in first out, or we also call this as the LIFO. And then the retail inventory method. First, let's talk about the specific identification. So when does the company use a specific identification? So this is specifically relevant, for instance, if the items are not ordinarily interchangeable or the items are segregated for a specific project. So it's like it's specifically identified. The inventories are identifiable in such a clear or easy way. Second, when we say moving average method, so this actually applies for those companies who have implemented a perpetual inventories accounting system. So under the moving average method, it actually requires the determination of a new weighted average inventory cost after or each time a company makes a purchase. So for example, every time a company makes a purchase, a new weighted average is being computed. Under the weighted average method, so these applies to companies who have implemented a periodic inventory accounting system. So here, even if the company makes a purchase, several purchases, there is only one weighted average cost per unit, which is used to determine the ending inventory, and that is computed by adding all costs. So that includes the cost of beginning inventory plus the cost of purchases during the period, and then we just divide it by the total units of inventory. So when we say total units of inventory, that includes the beginning inventory and then the number of units purchased during the period. So in the second part of the video, I'm gonna do a calculation for each one of this to make it clear because it's quite complex. So I wanted to make a sample for you guys so that it's understandable. Okay. So when we say first in, first out, so here typically a company does not purchase its inventory just one time. So it makes series of purchases, right? So the company's policy here is that whatever goods that the company has purchased, it should be sold first. So it's like first in, first out. So whatever has been purchased first, it should be sold first. On the other hand, when we say last in, first out, the policy of the company here is that whatever is the inventory that it has purchased recently, these are the same inventories which are also sold first. Last inventory purchases, these are the items which are sold first, first out, okay? When we say retail inventory method, so this method is used for, first is interim and annual financial reporting, which is of course in accordance with GAAP. Second, for federal income tax purposes, so in the US. Third is for verifying year-end inventory and cost of goods sold data. Okay? Okay, so actually I forgot to make a slide for the subsequent measurement. Sorry guys. So I'm a bit sleepy already. I didn't finish the last slide. Anyways, let me just talk about the subsequent measurement. So what do we mean by subsequent measurement? Okay, so I don't have a slide. I'll just talk about it, okay? So as a rule, inventory should be measured at lower of cost or net realizable value, okay? So in case if the net realizable value is lower than the cost, of course, company should record loss on write down, or a company should actually have an impairment. A company should actually book a loss on write down and record also a corresponding allowance account. So the impact here is a decrease in income because of the loss being recorded, and then a decrease in inventory because of the allowance being recorded. So it's important that a company performs an assessment whether cost is lower or higher than the net realizable value, and at the end of the period, a company should record its inventory at the lower of cost or net realizable value. I hope that is clear. So that ends this lesson. I hope this has been helpful to you. Comment below if you have questions or clarifications. Please watch the part 2 of the video. I'm gonna discuss about the calculation in great detail. So thank you for watching. My name is Jane. If you like this video, hit like, share, and subscribe. Till next time.